Let's talk about the VAT account. VAT account. So what is this VAT account? Okay. In your financials, all all the transactions related to VAT should have what? One account. Okay. What do I mean by this? Let's see. We purchased. Uh, okay. We're we're a dealer, right? Okay, so we purchased a motor vehicle for how much? Let's see, for $50,000, 50,000 USD. Just quickly format that. Okay, USD. And then VAT. Yeah, this is the price before VAT, before VAT. And then there is VAT of how much? 16.5%. So it'll be this one times 0.165. Right. So, what's the cost to us? The cost will be 50 plus 8,450. All right. So now we are selling this motor vehicle. Selling price, let's put it at 60,000. Okay, that is we're including our profit here. And then VAT, which is at 16.5%, that's the assumption, times 0.165. Okay, so let me just put here VAT rate 16.5%, right? So, and the cost we're selling will be what? That's the cost we're selling, right? That's the selling price, and that's the purchase price. So the difference between these two, this and this, is what? Is what we call the profit. Now, um, my interest is on this column. This column, the VAT column. This is my interest. Right. So let's look at the double entry for for each of these transactions. Right. So for the pages, for the pages, um, what do we debit? Okay. So we say motor vehicle. Since we're in a trading business, we'll debit what? We'll debit purchases, purchases, right? And then with how much? With only our 50,000 here. Okay. And the next debit will go to what? VAT. VAT on motor vehicle. Okay. How much is that? The amount is 8,200. Okay. So this is our debit, and here is our credit. Okay. And the credit will go to what? Bank or payables. If we have not paid by cash, right? So you add or just get this figure, right? So this one, this side equals control R, that side. Okay, that's case number one. Scenario number two, where we are selling, what do we debit, what do we credit? Okay, when we are selling on credit, it will go to what? receivables, or when you are selling by cash, it'll go to cash or bank. Okay, we agree on that. And okay, so it will go to, the debit will go to bank or cash or receivables. Okay, with how much? Um, how much are we receiving? We are receiving the whole amount after selling, right? So what will be the credit? The credit number one will be what? Will be revenue or sales count. By how much? Only by our sales will be the amount before VAT. The other credit goes to what? To VAT. Okay, VAT on motor vehicle what? Sales. Okay, by how much? By this amount. All right, so let's balance this account. Um, okay, you add Control R, Control Z, just copy, paste, and like that. Okay, so um, now my interest, as I said, is in this column, the VAT column. So let's look at what has happened to the VAT. Okay, if I create a T account, if I create a T account, uh, top border, then okay, 2, 2, 1, okay, and then I put something like that, right? So I've created a T account. I'll call it what? VAT. Okay. So I'll put all VAT entries into this account. So what are we saying here? They're saying um the purchase. What are we debiting? We're debiting VAT. So this is what? This VAT is what? Is input, and this VAT is what? Output. Because it is on what? On sales. So what will happen to this T account? So it means here we're debiting. So you debit this account, you say input. Yeah, you can add narration, purchase, purchase of motor vehicle. How much? This one, 8,250. And here again on the output, we are selling. Okay, we are selling. So what are we doing to the VAT? VAT what? We're crediting. So this is the output. So we say credit output. Okay, sale of motor vehicles. By how much? You get this VAT, right? So when you come to the end of the period, you can have other transactions here for the input, output. And then at the end of the day, you have to balance these accounts. Okay. So which side seems to have more figure? Okay. Which side seems to be more than the other? Obviously, it's the credit side. So I would do I do get something like that. and then I say balance, carry it down. So that is the closing balance. So the closing balance will be this one right here minus that one. So let me kill the formula by copying, Control C, then Control Shift V. I have killed the formula there, and then also do the what? The adding. Okay. Okay. Having done the adding, let me just put it like that, and here's the what? Just like that. Okay. So at the end of the day, the credit has more than the debit, and then opening balances. That will mean the balance brought down in the subsequent period will be how much? It will be 1650. So this credit balance, it means uh, it is a liability. Okay, it is a liability to the revenue authority. So at the end of the month, this is what we pay to the what? To the IRA, or in our case, in Malawi, we call it the Malawi Revenue Authority. Okay, so this is what we pay. So uh, this video is about the VAT account. We create a VAT account for all the what? For all the entries about what? On VAT. So in short, that this is what I wanted to share with you. Now, here is what the VAT account will look like. I extracted this from Franco. It's a business accounting book. So Franco one. So uh here's how it would look like in real life. So we're in this year, and then input tax, like we're doing the reconciliation, right? So for January, the input tax was 1,000, February 1,200, March 800. Then for the output, the same, and then the total for the output is more than the total for the what? For the input. Okay, so what was supposed to happen is the difference was supposed to be what? To be paid. So, and here there are also some adjustments. Say net overclaim of input tax from previous returns. Okay, so these are some of the adjustments. Okay, if you overclaimed, so that's the adjustment. Then here they are saying understatement, net understatement of output tax on previous returns. That's also another returns. Okay, uh, another adjustment, and then there is bad debt relief. Okay, so you may get a relief if you paid VAT for on your bad debts. Okay, so you make a sale, and then the on credit, and those customers default. So when you're selling that, there was some VAT involved. Okay, so it means you charge output VAT, and at the same time you you were charged input VAT. So that VAT relating to for that default amount, the bad debt portion, you also make the what? The adjustment here, right? And then at the end of the day, these are just others are just adjustments, all that. But I wanted to what I've presented here is just uh, the base for you to understand better. Okay, you say here you have all these complications, right? Um, don't mind about some of these, the adjustments. What you have to understand is that VAT has, you can have one account for VAT whereby all the transactions relating to VAT will be posted, right? And then at the end of the day, when the credit side is more than the debit side, or when the output VAT is more than input VAT, you pay the difference to the revenue authority, okay? The tax revenue collecting body, okay? When the when the debit is more than the credit, that is the input VAT is more than the output VAT, you claim the difference from the what? From the IRA or the in our case in Malawi, the Malawi Revenue Authority. With that, I've come to the end of the video. Thank you.